Hello and welcome to another episode of Darwin Investors. Today we're going to take a look at the week that we have going forward. I understand it, folks. I get it. We have geopolitical tensions. We got inflation. We've got the Fed's going to raise interest rates and crash us into a recession or possibly even a depression. But you know what? I'm still going to try and make money on the way down. I'm not going down without a fight, folks. So what I'm going to do is we're going to take a look at what I did last week playing earnings and what my plan is playing earnings this week. So let me go ahead and share my screen and I'll show you what I did last week. So last week, week of February 11th through February 18th, I made $111. They can't all be great big winners, folks. $111, but that's better than losing. It was a pretty bad week on the stock market, and I was able to actually make a little bit of money, which is I think it's kind of funny. This year, for whatever reason, it's my trading portfolio, the one where I got this cash on hand where I'm just trading in and out of stocks. That's the one where I'm making money. And then the one where I'm just buying and holding, at least for now, is not exactly making money. Unrealized losses down 6.65% for the year, but I'm doing okay trading. Let's go ahead and look and see what I did last week. So last week, if you look at Applied Auto Parts here, or no, excuse me, it's Advanced Auto Parts. I bought them for $223.98 a share. But then I sold them for $221.86 a share for a net loss of $212.61. That's the kind of shrewd businessman that I am. Buy it for $223, sell it for $221. However, if you include my options here, you can see that I sold a put. Oh, let's go with current month. I sold a put with a $210 strike, and that expired on February 18th for $299 and bought it back for $140. So my $212 loss turned into a $53 loss because I made about $160, or no, excuse me, $150 on this exchange-ish. And then what I ended up doing, the reason why I was up 111 and not down 53 was because I sold some puts on AMD that actually made a little bit of money and kind of made up the difference and gave me a $111 gain for the week. And you can see that for the month, still doing all right, but I didn't do much last week. And I didn't do much last week because I didn't see a ton of opportunities. And so this is how much I'm up. I'm up 48.12 for the month, this month, but I didn't see much opportunities last week. Let's see if there's any opportunities this week. So we're going to go to Tuesday. We're going to see who's reporting earnings tomorrow and see if these are the sort of things that we want to get into, or at least the sort of things that I'm going to get into. I'm not a financial advisor. Believe me, this is kind of closer to gambling than it is investing, but I don't know any other way to make money right now in the stock market. So this is the route I'm taking. Okay, so let's go ahead and start looking at some of these here. And what you want to do is kind of like based on past earnings of different of companies like them, you can kind of gauge at least kind of get an idea of what they might do in the future. So now we're getting a little later into the earnings season. We'll see if these are the sort of stocks we want to get into or not. Petroleum companies, they're fine, but they're trading near their all-time highs. Caesars Entertainment, stay the heck away from that. You see what happened to DraftKings? Stay away from that. Cracker Barrel, well, that one will probably be fine. That one is probably already trading near a high, because the food stocks and the retail stocks seem to be knocking it out of the park this earnings season. So if I look at Cracker Barrel, it's probably trading near, yeah, see, it's closer to the top. Well, it's in the middle here, but over the last month, you can see it's kind of trending upward as these food stocks tend to be doing well. Even as the broader market is doing poorly, these food stocks are up 10.21%. So these are where you want to be, at least in the last month. Same with the petroleum companies. If we look at FANG here, probably the same deal. Let's look at FANG stock over the last little bit here. I'm guessing it's probably going to be up over the past month, or yeah, it is. It's up again 10%. So these aren't the things that really intrigue me. I don't really like playing earnings on stocks that are already up. If I have a stock that's already up and it just happens to be in my portfolio, I'm playing earnings. These are the types that I tend to sell a covered call against my long position because I don't think they're going to go up that much. And if they do go up, then I'll make a little bit on the underlying. I'll make a little bit on the covered call. But again, these are a couple I'll stay away from. I'm going to stay away from the food and I'm going to stay away from the energy because they're already trading near their highs. Let's go on down here. Okay, so now we have Home Depot. Home Depot was interesting to me. because I own Lowe's, and I'm gonna actually make my Lowe's trades after Home Depot reports. Home Depot is one that kind of like tailors their business more towards contractors and professionals, and Lowe's seems to do a little bit less towards contractors and professionals and more towards home enthusiasts. And actually, to be more pointed about it, Lowe's is actually kind of tailored more towards women. When you walk in the door, it's like Target. It's bright. It's blue and yellow. There's a lot of appliances there. And then Home Depot is like brown and red and dingy and got sawdust on the ground. It doesn't get as much retail traffic from, say, women. So Home Depot can actually report earnings and look kind of poor because they say, oh, well, retail sales are down. And then Lowe's can report the very next day with strong retail sales. And so that being the case, I'm still going to be at very close attention to the construction sales of Home Depot. If they're really strong, I'm going to go pretty heavy at Lowe's. So Home Depot is definitely one I'm going to be keeping an eye on. Louisiana Pacific, again, that's another home builder stock. Macy's, now Macy's would be one to really, the retail stocks are knocking it out of the park this earnings season. I'm loving retail. Macy's looks like let me see if it's up. It's really not too much. It's at 25. It could go up to like 29 bucks after earnings, get you about $3 a share. I think that's pretty conservative. It's trading at a low price to earnings ratio, so analysts are going to love that. This thing, it's got really nice an online presence now that it didn't used to have. This is an interesting one. It's not the one I'm going to get into, but man, it looks interesting to me. If I was going to gamble, and believe me, I do, this is a good one, and I might still, but I don't think I'm going to. But I do like Macy's. Mercado Libre, stay the heck away from that one. Okay, I know Amazon blew it out of the water. Their earnings, they didn't though, but people seem to think they did. And Mercado Libre is going, I think, unfortunately, going to be more closer to Shopify than to Amazon. And Shopify really laid an egg, so be really careful if you're trying to play earnings on Mercado Libre. Palo Alto Networks. Now, this is an interesting one to me because they seem to like they're going to be the very first of the big cloud players that's coming out. We got Palo Alto Networks, we've got CrowdStrike coming, we got Zscaler coming, we got Snowflake coming, and this is going to gauge how the market kind of feels about some of these cloud stocks. And we'll get into Twilio in just a minute because Twilio already reported, and I'll show you what happened to them. But Twilio came out and did really well at first and then kind of tailed off. And we'll get into why that was. Let's see, anything else on this day? Teladoc is one some people are interested in. I'm not. They lose too much money. Toll Brothers is a really good one to me. I know that home builders, people are saying that home building are not going to be that strong this year, but Toll Brothers, they're a high-end home building. And unfortunately, or fortunately, however you want to look at it, when you're talking about high-end stuff, people that have a lot of money don't tend to care that as much about inflation and about buying things. And so Toll Brothers is still going to have, is because of their audience that they sell to, they're actually one that's probably going to be largely unaffected by inflation and that sort of thing. Plus, they bought their stuff a long time ago. A lot of these home builders, they don't just buy it like right before they build the house. They've had it in stock forever. And Toll Brothers, oh wow, that was down from 60 to 54. Okay, this is a good one, folks. I might get into this one too. So Toll Brothers looks really good. So that was a little bit of a surprise to me. I thought that they would be up, but Toll Brothers is a good one. Their price to earnings ratio is always going to be super super low. They pay a small dividend, but 8.15. This is going to be one that analysts are going to get behind, and I think they're going to give you good guidance, and that's going to be a surprise one. I think it's going to be Toll Brothers this week. What else have we got here? Nothing else looks very good to me on Tuesday. Let's jump to Wednesday. So on Wednesday, what have we got on deck here? So we've got Bath and Body Works. That one always seems to do really well. I'm just not a big believer, but it's probably gonna be fine. It's gonna go straight up. It always does. But I'm not a believer. Booking Holdings, their stocks cost a fortune. If they do a split, maybe I get in on it. Expedia did well, or B&B did well, so Booking's gonna do well, but who can afford their shares? So I'm gonna pass. Let's see here. eBay, look out below. For the same reason as Mercado Libre and for Shopify. Ingersoll Rand, look out below. You can, like I said, you can gauge what one stock is going to do based on similar stocks. Caterpillar suffered, John Deere suffered, Ingersoll Rand would in all likelihood follow suit and suffer as well. Jack in the Box will do well because they're a food stock. Because they're a food stock, they've probably already gone up. But let's go ahead and take a peek here. Jack in the Box. Well, no, not really. They're over the last month, they're still up. See, the fact that they're up at all in the last month, given the way this market's been behaving, just shows that they're doing all right. But they could have a little bit more upside, but I'm not interested in Jack in the Box anyway. Lowe's is the one I already own. I'm going to sell a put on them. I'm going to maybe sell a covered call on them after Home Depot reports, when I can get a really good idea of how I believe they're going to report. And let's see what else we got here. Revolve. Revolve is the one I'm really interested in, and this is the one I think where I'm going to actually play my hand. Revolve, if you look at them for the past, say, 6 months or so, they're well down. They had a high of like $87. They're now down sitting here at about $54. They have a price to earnings ratio of 45. And one of the things that I really also like about them is, one, is their financials, but two, they've been given a very low bar to get over. When I look at them here, they only expect 18 cents earnings per share. Now, this is after Christmas, folks. Revenue of 221 million. Well, if you look at their previous quarters, beat by 50%, beat by 99%, beat by 131%, beat by 136%. And why is that? Well, they've given them, last time they reported 244, they expected 214, and now they're saying that they're going to 221 this quarter. They're expecting 18 cents a share. Well, last time they reported 22 cents a share. If you look at the quarter before that, again, 42 cents a share, and then 228 reported. You look at this, 30 cents a share, 178 reported, and then what else we've got here? 26 cents a share, 140 reported. So let's go ahead and take a bigger look at Revolves Financials. Again, I do believe they'll be able to get over this bar and that bar pretty good, and I think that they're going to guide well as well. So let's look at Revolve's financials here. So if you look at them from 2020 to 2021, net sales have gone way up. That's about 200 million. So that's about a 50%, maybe 60% increase on sales. But what's the most important thing here is, are they making any money? So let's look at their operating income here. Their net income is up 70 million from 37 million. So they're not a money losing company. We've already established that they have a price to earnings ratio. They're growing at roughly, if they go from 37 to 70, they're growing at roughly 100%. That's really close to 100%. Their earnings per share diluted went from 52 cents to 95 cents. They're expecting another, what was that, 20 or 18 cents, but probably more realistically 22. So we're going to be looking at about $1, $5, $15, $17 a share this year, which is going to be really sweet. They don't really dilute shareholders. This company has got some really rock solid fundamentals. Let me see if I can get the total operating expenses right here. So 285 on 581 versus 182 on 439. So it looks like that's roughly just a little bit more than double, like 2.5, and this one is also about the same. So though their revenues are growing, their operating expenses aren't really growing. So that's a really good sign that they've done their expansion. So without belaboring the point, I really like Revolve. I'm going to take a stab at them. That's going to be the one I'm going to take a look at. So I think they can go up a bit just because of their growth and the amount of money that they earn. And I don't see anything else on this day that really excites me. So let's see. And their retail, and retail's been doing pretty well this earnings season. So and their stock price is down. So for all those reasons, I'm liking Revolve. Let's see here. Alibaba, I'm staying away from any Chinese stocks, no offense, but they're not doing, people are just sour on them right now. Beyond Meat could surprise. I don't know why they lose so much. They do an awful lot of business. It's a mystery to me why they lose money. I can only blame management or something. There's something wrong with this stock. I just can't put a finger on it, but I can put a finger on it. It's losing money, but I don't know why. They tend to be the big player, and yet there they are. I haven't really looked into them. Square, hey you guys, be really super careful with Square. Let me go ahead and show you the reason why. If we look at Square stock, first of all, it is way down, and this is over the past 6 months. it's down, gosh, from 270 down to $97. And you may think it's down to $63 or 63% the past 6 months. How much further down can it go? Well, a lot further down, and I'll show you why here. If we look at their if you look at their total net revenue, it's 13.5 billion. But look at this, they have a special spot here for Bitcoin revenue. And their Bitcoin revenue is 8 billion. And last time it was 2.8 billion. And that could be good, except for their Bitcoin costs were 7.8 billion. And then the other problem that, so what they make their money off of is that their transactions and their subscriptions. Their subscriptions is where they make. See, look, they pay 346 million for subscriptions and made 1.9 billion. Hardware revenue they lose money on. Look at this. They made 109 million on hardware, but their costs were 153 million for their hardware. So what they're doing is they kind of give you their hardware for basically lower, they lose money on their hardware so that they can turn around and make money on their software and their subscription and their transactions. So that's what they're doing. They kind of lure you in that way, and then they boost their revenue through Bitcoin, but the Bitcoin doesn't have any margin at all. So guys, I just saying, be really super careful with Square. That would be one that I'm going to definitely stay away from. And because it's Bitcoin related, I'd also kind of be kind of leery of Coinbase. Dell's always an interesting one. You know, every time that there's an earnings with these legacy type of tech stocks, be they Dell, Micron, Oracle, Texas Instruments, you know, some of the lower PE tech stocks, they tend to get very favorable. The analysts come on CNBC and they tend to drool over them for like a day or two, and then they go back to where they came from. But Dell is one of those that trades at a price to earnings ratio of 6.81. They're going to declare their earnings. They're probably going to go back up to like $63, $64 before they go right back down to $54. But for a couple of days it was like, you know, this is a good deal, and then a couple of days later you're like, well, is it a good deal or is it a value trap? Well, you know, at least for earnings, if you want to play it, Dell's a super safe one. It's not going to hurt you. Probably going to go up, not likely to go down, and you can make a little bit of money on Dell. But I'm not going to play Dell. Etsy again, see Mercado Libre. That one's going to be it could be a bit of a problem. I don't know. I don't know. Well, it's a retailer actually. I don't know. I'm staying away from that one. And then Open Door, wow, look out below. You saw what happened to Redfin. Wow, same thing's going to happen to Open Door. Any of these home flipper ones, the only reason why Zillow's going up is they got rid of their home flipper business. Man, look out below on Open Door. Please don't invest in this company. I'm sorry, I can't say that, but be very careful. If you are investing in this company, be very, very, very careful this earnings season. Rocket Mortgage, same deal. Be really careful with these guys. The home refinance, because of the interest rates going up, this is going to be a problem for them. They're going to have pretty poor guidance because of the interest rate rising. And then Zscaler. Okay, so Zscaler, you're going to take a good look at Palo Alto Networks, see how they report. You might get a good idea of what's going to happen to Zscaler. Zscaler is one that I find that's a little bit on the scary side. Because I have a feeling what could happen to them is something like what happened to Twilio. Twilio reported on February 9th. You can see they went from 202 to 205, and then from 205 they went down to 158. So they lost a lot of money. Why did Twilio lose money? Well, Twilio lost a lot of money because, well, they first gained money because they saw how much revenue they were making. They're like, wow, look at how this big revenue increase is so awesome. Gross profits way up from where it had been. But then when you start looking at their loss from operations, their operating expenses were 2.3 billion, and these operating expenses were 1.4 billion. And then when it's all said and done, their loss from operations was $949 million as opposed to $490 million last year. So somewhere in here, they lost a ton of money. And that's what's caused their stock price to come down. So they went from losing $3.35 a share in 2020 to losing $5.45 a share in 2021. And so though this number was nice, people liked that at first, and people liked this one at first, and people even liked this one at first, looked like their losses were going down. At the end of the day, people didn't like that the earnings per share were going down and that they were diluting their shares. And I'm afraid that that's something that Zscaler could suffer from. It's because they have a very similar looking balance sheet. We have a company that's gone up. It's going to, looks like it's going up, you know, about 80% or so. Gross profit is going up. But when we look at their loss from operations, it's also going up. Their loss from operations here is 153 million versus 142 million in revenue, and their losses here is now 252 million versus 230 in revenue. So this company went from losing 41 cents a share to 65 cents a share, and they're dealing with a little bit of dilution as well. And so this is one I think that could follow a similar path to Zscaler in this, or to Twilio, in that they might get a little bit of a bump, but then man, look out below. So that's one I'd be pretty nervous about as well. And I didn't mean to say don't buy Open Door. I'm not allowed to say that anyway. I'm not a financial advisor. I'm just saying be really super careful with Open Door. Occidental, that would be another one of your oil stocks that's probably trading near a high right now. And let's see here, what do we have on Friday? And then on Friday, we've got Foot Locker is reporting, Lee Auto, Northern Oil and Gas. Again, this one will probably be okay. You're probably not going to lose too much. Lee Auto, I have no idea. Foot Locker, they always turn out a great quarter. Then they might even do something like raise dividends and do stock buybacks, and their stock will still go down. And I don't understand it. It's a fantastic value. If you look at Foot Locker value, these guys sell some shoes. I mean, and they own more than just Foot Locker. They've got a lot of different ventures going on. They buy a lot of in different countries as well. They own a lot of different subsidiaries. And so they've gone from like $60 a share down to $42 a share. They have a price to earnings ratio of 4.85 and a really nice dividend yield. But nevertheless, they tend to suffer a little bit on earnings, but they can have a pop this time. So yeah, there you go, folks. So my plan this week is I'm going to go ahead and I'm going to trade Revolve, maybe Macy's, definitely Lowe's. I'm going to see if I can't make a little bit of money this week, and what I expect is probably going to be another bad week in the market for unrealized losses. But yeah, if you got anything on this, yeah, please like, subscribe, hit that little notification bell, and until then, we'll see you next time. Bye.